Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. And don't forget, Trish Regan is now part of the Stansberry family. Check out her podcast, American Consequences with Trish Regan. The link will be in the description of this episode. Today, we're going to talk with Scott Helfstein from ProShares, the ETF company. Hey, seems like a good time to talk to somebody about ETFs given the rise of passive investing. This week in the mailbag, it's Bitcoin, 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 and more Bitcoin. In my opening rant this week, I'll talk about the Amazon effect, Bitcoin copycats, and George Soros' theory of reflexivity, whatever that might mean. That and more right now on the Stansberry Investor Hour. All right, let's start with the George Soros theory of reflexivity. If you've ever read George Soros, The Alchemy of Finance, or I think a better source is Soros on Soros, Staying Ahead of the Curve, which is really a book-length interview with Soros on all kinds of stuff, not just investing. So if you've ever read either one of those, this sounds familiar to you. And I have to say, The Alchemy of Finance is like some of the worst writing I've ever tried to read. And this theory of reflexivity, oddly enough, like Soros goes in circles trying to explain it. So I'm just going to simplify it with my simple understanding, okay? My simple understanding is that the theory of reflexivity is at least in part about how market prices aren't just the effect of economic fundamentals or business fundamentals, right? I mean, it's a typical thing, right? A company comes out with good earnings and the stock goes up, right? The fundamental is the earnings and the effect is the stock price. But the theory of reflexivity says, well, sometimes, maybe not all the time, but sometimes, especially in a bubble or a boom-bust sequence, is how Soros would put it. In a boom-bust sequence, the market price becomes an influential fundamental in and of itself. Okay, so it influences the fundamentals of the business, let's say, if it's a stock price. And this fellow, Elliot Turner, on Twitter, he put out this perfect tweet. That's why I'm discussing this, because Elliot Turner, who I follow on Twitter, he put out this perfect tweet, and he said, MSTR, which is MicroStrategy, the company run by Michael Saylor that famously announced that it was buying Bitcoin last August. Right, and the stock is like $900. It was $100 then, it's $900 now just because they bought Bitcoin. And MSTR is the ticker symbol. And Elliot Turner said, MSTR is the best example of Soros reflexivity I've seen in markets. And then he lays out the sequence. MSTR buys Bitcoin, the stock goes up. The act of buying itself makes Bitcoin go up. Then the stock goes up more in relation to that. Then they issue equity, and they've recently issued debt as well, right? So they can buy more Bitcoin, which makes Bitcoin go up, which makes the stock go up. I mean, it's just this circle, right? This reflexive circle. And, it's a virtuous circle until it becomes a vicious one, right? And they recently issued $600 million of senior notes, I think it was, some kind of debt. And they'll use it to buy Bitcoin, I bet you. Now, I agree, that's a classic example of reflexivity. And I think this can go on in the overall stock market too, right? People buy stocks and the demand causes the stock prices to go up. And then the stock prices go up and people feel wealthy. So they spend more money and buy more stocks. And they feel wealthier, and it's back and forth. So the wealth effect becomes reflexive. And you've probably heard of the wealth effect before. So the reflexivity can work with any situation. And in fact, in Soros on Soros, he says that that's how you know when the boom-bust sequence has begun. Because you get this moment where the thing that's supposed to be the effect, the price, the asset price, becomes a fundamental, and it becomes an increasingly important fundamental. And that certainly has happened with MicroStrategy. In fact, a Bloomberg article did this little breakdown. It's a recent Bloomberg article. I think it came out Wednesday. And they basically concluded, they looked at the number of Bitcoins that the company already owns, that MicroStrategy already owns. And then they thought, well, if they issue this 600 million, they can buy some more coins. And then they'll have this much, and there are this many shares, and it's this much of a share price. I don't want to go through the whole thing. You can read the article in Bloomberg. But the bottom line here is that and they admit it's a kind of a crude analysis. So they conclude crudely the difference, between the value of the business and the value that people are attributing to Bitcoin. Attributing this difference to its new Bitcoin business would mean an investor who bought the stock today would pay about $75,000 per Bitcoin. Bitcoin is $50,000 as I speak to you, $51,000, I think. So they're overpaying for Bitcoin by buying this stock. Like all in one concentrated stock, MicroStrategy, ticker symbol MSTR, you have just all the classic signs. Right? The reflexivity is in place where the stock goes up, Bitcoin goes up, et cetera, and it changes the fundamentals of the business. It makes them a better creditor, right? They're able to borrow this probably because the business is now worth, 7 or 8 times what it used to be. It's crazy. The stock goes up, it makes them a better creditor. They can borrow more, they buy more Bitcoin. It's crazy. And I think it's something you need to get. You need to understand it. Let me just move on a little bit. So you can see a similar effect in the zombie companies, right? We talked about this before. I think it's still 18% of American corporations, and I think that's probably publicly traded, I'm going to guess. American corporations are zombie companies. They wouldn't exist if they couldn't get some kind of a bailout, usually in the form of another loan, right? And recently, our friend Jason Gefford and his team at Sentiment Trader put out a chart on Twitter where they showed that profitless companies losing money, right, with no profits in the Russell 2000, were just soaring out of sight. I mean, they're outperforming everything. The chart is ballistic. It's a ballistic missile, straight up. And here again, you have the same effect because creditors like a big equity cushion, and the equity cushion gets bigger the higher the stock price goes, right? So they say, well, the equity's worth $1 billion and it was worth, $100 million a year ago. And so let's lend them some money and see if they can, pull this thing out or whatever. And part of that, I have to admit, is what I might call the Amazon effect. That's at work here too. And I want to talk about the Amazon effect for a minute because I think it's at work in Bitcoin. I think Bitcoin and Amazon have a similarity, and the similarity is this. Amazon peaked, split adjusted, if you just look at a historical chart. I think it peaked around $80 and it troughed out right around $6. Just eyeballing a chart real quick this morning. Back during the dot-com era, right? So that's a huge drawdown. That's a major crash. But let's face it, you could have paid $80 at the top and you'd be doing okay, right? You'd have had a major winner on it. You'd be rich on Amazon alone, right? You could have bought at the top of the dot-com bubble and you'd have been right on the money if you just held on to your shares. And, if you bought more down to $6, whoa, you're really rich. So in other words, it was a huge bubble and it crashed. But, and Soros points this out too, there was a lot of truth in it. The internet really did become a huge force in the world in every way, right? In our culture, in every human life, just about. And even if you are a poor person in the remote, some remote part of the world, not having the internet is a huge effect in your life, right? So the internet affects every living human being even if only negatively by not having it. So it really was the most amazing thing. So the bubble kind of got it right. It just went way too far. Soros talks about that too. He says, it's the divergence between the reality. He says all bubbles are based in some reality. They don't happen by accident. They happen because people are kind of right about something. And they were right about the internet, and they were right about Amazon being like the greatest business ever, as time has proven beyond a shadow of all doubt. And Bitcoin looks that way to me. Bitcoin looks bubbly just because if you look at a chart, the thing has gone ballistic. I recommended Bitcoin just about a year ago, almost to the day here, in extreme value, and it's up 400 and some percent. At 51,000, I think it's up exactly 400% from where we recommended in extreme value. So look, that's a ballistic chart, and ballistic charts don't sort of level out and go sideways. They go ballistic straight up and ballistic straight back down. Am I recommending selling Bitcoin? No, and the details of that are really for extreme value readers. But I think there's more upside here, is I guess the shorthand. But I think it's like Amazon, because I think blockchain and Bitcoin really are enormously huge innovations, like, internet sized potentially, relative to the financial world. And what the price does from here, come on. One guy, Scaramouche went on CNBC earlier this week and said it's going to be $100,000 before the end of the year. Well, look, when a guy like him goes on TV and says it's going to be $100,000, that's kind of a sign of the end. That's not a sign of the beginning. But another fellow argued to me today, said, maybe Bitcoin has already had its Amazon moment, right? Because it peaked up around, in 2017, that was like up around 19,000 or 20,000 or something, and then it crashed back to 3,000. So maybe that was the sort of Amazon.com peak trough moment. And from here on out, it's proven itself, so to speak. I don't think it has proven itself, but I think it's a really good bet. And I think it's changed the world already, and it's going to continue doing so. And BlackRock came out this week. BlackRock, the biggest asset manager in the world, they have like $7 trillion with a T under management. Rick Reeder from BlackRock, or Reeder or Ryder, I don't know how you say his name. He says they're just dabbling in it now, and they're not like recommending any percentage in a portfolio or anything like that, but they're dabbling, right? BlackRock clients want Bitcoin, so they're giving it to them. And and you've seen other developments recently, right? Bank of New York Mellon. They're allowing Bitcoin to sort of enter their ecosystem. And even Elon Musk at Tesla saying, they put $1.5 billion in cash into Bitcoin. And there was this Financial Times article that said, there aren't going to be any more of these copycats. I think that's not true. I think there will be more copycats of Elon Musk. There will be more corporate copycats allocating some of the treasury to Bitcoin, because that's just the way these things go. I understand the argument in the article was, well, people want to put the corporate treasury in something stable and safe like cash or short-term treasuries or something like that. Cash and cash equivalents. If you read enough balance sheets, that's the phrase. Cash and cash equivalents, or cash and short-term investments, right? And, Bitcoin is all over the map. It's really volatile, so it doesn't really qualify. And yet it makes sense. And these two companies, MicroStrategy and Tesla, have come out and said, yeah, we put a real serious chunk of the corporate treasury into Bitcoin. And they're tech companies, so that makes more sense. And they're run by, these, I don't want to call them crazy, but they're on the cutting edge. They want to be on the bleeding edge of financial technology, as well as their own technology that they're selling. So that makes some sense that it would happen first in that kind of a company. But, I could certainly see like maybe a Google putting a little money into Bitcoin, or, any of the FANGs, right? We could see that. And it wouldn't have to be some huge amount. It could be, we're putting 10% of the corporate treasury, or 5% of the corporate treasury, or 1% into Bitcoin. And that would be enough, I bet you, to, push it up another 5 or 10 grand or, 2 or 3, whatever. It would affect the price, wouldn't it? And the more of those announcements you got, the higher it would go. So we've talked about a lot of things, but I really want you to think about that reflexivity idea, because I was asked earlier this week in a meeting with the other Stansberry editors, Austin Root, our head guy in Stansberry research. He's the head research guy anyway. And he says to me, Dan, what do you think causes this, bull to turn into a bear or crash or correct or whatever? And I said, you don't get to know that. But I do think that the stock market has, it's gone past that boom bust threshold where Soros would say, yeah, it's become a fundamental now, right? The stock market has become a fundamental, and you've seen the stories, right? People trading on Robinhood and saying, yeah, I'm a day trader now, and I've quit my job. Or, some people who got involved in GameStop said, the fundamental went against them, right? They lost all their money and they can't pay their rent. Either way, it's there. Those people have got us there. They've got us to the point where the stock price becomes a fundamental affecting real economic behavior. So I think we're there. And my answer to Austin was simply, I can't predict it, but it's begun. And how far away the ultimate top is and the crash is, I don't know. But if the market is down, 40% a year from now, or 2 or 3 or whatever it is, it won't surprise me one bit. That's all I want to say about that. I'm going to do a quick quote of the week here, and then we're going to talk with our guest, Scott Helfstein. And my quote is actually quoted in the book that I'm taking it from. So the author quoted this, and I'm quoting the author quoting this. So it's sort of a double quote. And the book is essential reading, for especially given the time we're living in now. It's Devil Take the Hindmost, A History of Financial Speculation by Edward Chancellor. It is absolutely, hands down, without qualification, the single best book on the history of financial speculation, and one of the very best financial history books, period, that you will ever read. It is must reading. Put it at the top of your list if you haven't read it, and you will enjoy it. It's really well written, and it'll make you feel smarter, and you'll have things to say at cocktail parties. It's wonderful. So right at the beginning of chapter 1, which is called This Bubble World, The Origins of Financial Speculation, Chancellor quotes the Satyricon of Petronius Arbiter, circa AD 50. So from the year 50, okay? And here's the quote. And when dreams deceive our wandering eyes in the heavy slumber of night, and under the spade the earth yields gold to the light of day, our greedy hands finger the spoil and snatch at the treasure. Sweat, too, runs down our face, and a deep fear grips our heart that maybe someone will shake out our laden bosom where he knows the gold is hid. Soon, when these pleasures flee from the brain they mocked, and the true shape of things comes back, our mind is eager for what is lost and moves with all its force among the shadows of the past. I really like that. I just like the poetic sound of it, and the fact that you've got the boom and the bust all in one sort of poetic little paragraph here. And he says your laden bosom, right? You're clutching the gold to your chest, and then when it's all gone, your mind moves with all its force among the shadows of the past. You'll never forget when you had it. I think it's a good thought for the current moment. Think about boom busts. Think about the history of finance and how many times this boom bust thing has happened. I like it. I hope you liked it too. Write into feedback@investorhour.com. Either way, let me know what you think. Right now, we're going to talk with Scott Helfstein. Let's do that right now. Before we move on, there's an opportunity I want to bring up. It's the biggest digital disruptor of our lifetimes, and it may have already arrived. It could be tied to every paycheck, every tax bill, and every investment. Now, one early investment in this trend could make you more money in the coming years than you probably ever made before. To get all the critical details, visit techtrend2021.com. All it would take is one potential announcement from the biggest employer in the United States to kick off a potential frenzy in this new space. That website again is techtrend2021.com, all one word, techtrend2021.com. Check it out. Today's guest is Scott Helfstein. Scott is a PhD. He joined ProShares and ProFunds as Executive Director, Thematic Investing in 2020. Wow, a cool year to change jobs, huh? He is responsible for product development, investment research, business strategy, and external engagement for the company's expanding lineup of thematic ETFs. His work focuses on innovation and the evolving trends at the intersection of technological, economic, and social disruption. Prior to joining ProShares, Scott was head of thematic portfolios and co-head of market research and strategy at Morgan Stanley Wealth Management, launching the firm's thematic research and portfolios and managing a team that provided global multi-asset investment advice. Scott earlier served as senior investment strategist and deputy to the chief market strategist at BNY Mellon Investment Management, responsible for global macro, relative value, and political analysis. He also worked at the Federal Reserve Board of Governors and was an investment banker at Credit Suisse First Boston. Wow, hell of a resume there, Scott. Welcome to the program.
Thanks for having me. It's great to be with you.
So, Scott, I just saw that Federal Reserve. I didn't notice that in your bio before. What did you do at the Federal Reserve?
So I actually was a co-op analyst. I worked almost full time, about 35 hours a week for my last 2 years in college. I started with the research and statistics group, where I was writing computer code to check banking regulatory filings. And then after about a year, moved into the financial analysis group within banking supervision and regulation. And I kid you not, that it was right around the time of the Financial Modernization Act. So I was writing memos with other analysts on the repeal of Glass-Steagall and the future of banking. Subsequently, by the way, in your resume, you might see that after my PhD, I taught at West Point, was a professor of social science. I felt like I needed to go back into public service because some of our conclusions around Glass-Steagall and the future of banking back in the late 90s might not have panned out so well.
I see. So let's see, was this during Alan Greenspan's tenure or Alan Greenspan, right?
It was Greenspan. And as my parting gift, my boss, the section head, allowed me to present research to Alan in one of the board meetings, to which he ended by saying, and as soon as you get asked a question, if you would like to just defer to me, that's perfectly acceptable, which I actually opted into in that moment.
I'm sorry, explain to me what that means. If you would like to defer to
So if I wanted to defer to my boss to actually answer the question, because here I was 20 years old, standing in front of Alan Greenspan while still in college, and presenting a 5-minute piece on subordinated banking debt spreads. And he, of course, had a couple follow-up questions. And I, as an intimidated 20-year-old sitting in front of, the world's leading central banker, decided perhaps I should let my boss take it from there. Discretion and valor, Dan.
Okay. Yeah, I guess I probably would have done the same thing. But it's cool. I mean, you had your moment with Alan Greenspan. And any impressions of him or no? He just kind of sat there and asked a few questions or what?
I thought he was very, very smart. At the time, if you recall, throughout the 90s, most of Wall Street viewed him as an oracle. And it wasn't until sort of 2008, 2009 that we went and we revised some of the history about his decisions around monetary policy, at the time and the inflation of the asset bubble. But I always thought he was absolutely extraordinary. And my time in the board meetings was, confirmed that view. So I think he was a brilliant banker and an exceptional public servant.
Okay, I mean, I could probably pepper you with questions about this because, the Fed is something everybody likes to think about and talk about, but we'll move on. It's cool. This is not where you spent your career, right? But I remarked when I was reading your intro here that you changed jobs in 2020. Like, when did you change jobs? What month did you change?
So I actually changed at the end of August, and at that time, I had never either stepped into a ProShares office, nor had I in person met any of the people that I was going to be working with. So the entire interview process was done virtually. Everybody was remote at different locations, and onboarding virtually was a very unusual experience as well. So you're spot on. 2020, an interesting time to make a move, but it's been great being at ProShares.
Yeah, I don't know. I feel like I have to know more about this. Like, last year was, the year of distress and craziness, and the world just changed in such a way nobody predicted it would change like this. Did you go to ProShares just, I mean, let me ask you it this way. Did the craziness of 2020 heavily impact your decision to move on, looks like from Morgan Stanley Wealth Management to ProShares?
No, it didn't. I think it perhaps accelerated some decision making around that process, but I believe that there is a really strong tailwind behind what we are now calling thematic investing, and I'm happy to dive into this more. I think about that as kind of an inside baseball term more than anything else that is getting a little bit of press attention, but I really wanted to be on the product development side after founding and leading the thematic research effort for Morgan Stanley for 3 years. And so for me, it was really about finding that right next step to move into going from the conceptual and the product analysis to the product development and the ETF strategy. And so when the opportunity arose to kind of do it all and lead the charge, that was pretty appealing to me.
I see. Okay. So Scott, yes, we will. Let's move on and talk about, thematic investing and, the intersection of technology and economics and social disruption and all that. But Scott, first of all, I mean, I have to, it's like full disclosure here. I have come to think over the past, I don't know, several years that, Wall Street, this Wall Street machine and, ProShares, Morgan Stanley, like, you're a Wall Street guy, right? So I've come to think that Wall Street is just cranking out too many new products that kind of don't need to exist. And a lot of them are ETFs. And, I don't know. What do you think of that? Like, the world, there's more ETFs there are more like funds than stocks now, aren't there? I know there are many, many more indexes than stocks at this point, listed stocks, right? And, it seems like there's an ETF for every darn one of them, at least one, right? How do you feel about this? There's been a huge proliferation of these products. Some of them, especially the ones that are based on futures, I don't know if they're doing anybody any good. Do you feel like talking about this at all?
So I think that ETFs are a great tool for investors to represent a wide variety of views. And I think, if you take a step back and you think about the evolution of the ETF industry, right? Phase one, ETFs replicate the indexes. They provide a cost-efficient and operationally efficient way for investors, to gain liquidity, oftentimes at lower costs and gain broad market exposure. Phase two, they start to go into some of the specialty areas, particularly around industries and sectors. And sectors and countries. And so this had been the purview of, more specialized mutual funds or institutional investors. And it opens up that world for retail. And then in phase 3, it's about smart beta, quantitative factor investing, which had been, again, the purview of some mutual funds, many hedge funds, and quantitative trading desks. And so here we are, where I think we're, on phase 4, and it's what we're going to talk about a little bit more, thematics. But I think when you consider the different set of flavors and the evolution of the industry, I don't think it's surprising that there are a number of products. And I also think that that provides, a number of different options for, the retail, or quite frankly, the institutional investor, to express their views. And, we decry markets, or bemoan markets that have very few options, and, if it's one company, we call it monopoly. And here we are looking at, big tech and regulatory issues, and, whether there is enough competition and there's too much concentration. And so, I think on the other side, we want to be careful about saying, well, there's too many choices over here, because the alternative, which I think we wouldn't be happy with, is if there were too few. I would also point out that, while there certainly were a number of launches in 2020, I don't have the numbers directly in front of me, so you'll have to excuse me for that. There were also a number of closures in 2020 as well. So I think that the landscape just continues to evolve. And personally, I would rather see more players and more products competing in the marketplace than too few, and higher fees and monopolistic attitude, and quite frankly, a lack of creativity of what's coming to the marketplace. I think that would be a shame.
Okay. Yeah, I hear you. So let's do this. Let's talk about thematic investing. What does this buzzword really mean, Scott?
That is a great question. And it's been really fascinating the last few months to see it pop up in the Wall Street Journal and Barron's and Bloomberg and Business Week and all these popular forums. Thematics to me really started as kind of an umbrella concept that represents investing through ideas rather than established paradigms. And so the phrase I use is thematic investing should break the style box, by which I mean, traditionally the style box looks at growth value, looks at the size of a company, and evaluates, a fund, a mutual fund, an ETF, based on what it holds in kind of a grid. And so we traditionally take a growth value approach. Perhaps we take a sector approach where we're overweighting and underweighting certain sectors. But thematics allows us to move away from, these investment constructs that might not be relevant for the moment or as relevant into the future. For example, we can talk about sectors, but I would argue just about every company today better be a technology company, because if they're not, then they're really going to struggle within their respective industry, and they're going to have trouble surviving the decade. And yet we still have a tech sector, a specific sector that's called out as the tech sector, which I think masks the fact that there is all this technological innovation going on across many, if not all, parts of the economy. So, I think thematic investment started as an inside baseball term for those of us who were trying to create pockets of opportunity that were outside of these traditional investing approaches. And it's interesting that it has kind of come out to the mainstream, because I don't, or filtered its way out. I don't think that, many of us in the cottage industry, if you will, had really thought about that or intended it. We just used it as a way to, to kind of bring together ideas around disruption in the future of the economy and some creative options for investors.
Okay, well said. So that's our definition. Maybe let's drill into this. I'm on the ProShares website, and the first thing, like right on the front page, you can select ETFs by type, and thematic is one of the types. They've got some interesting names. It's sort of like as soon as you look at this list, it's sort of easy to figure out what you mean by thematic. One of them is called Decline of the Retail Store ETF. Another one is called Long Online Short Stores ETF. Another one is the Pet Care ETF. And then there's a separate online retail ETF. Ultra NASDAQ Cybersecurity, Ultra NASDAQ Cloud Computing. Ultra, I assume, means levered.
That is correct. Those were launched last week.
So these are the current themes. Are you allowed to tell me what themes you're working on, or do I have to wait until they get launched?
I think we can talk about ideas. I would also add, by the way, we did it in the back half of last year, launch a multi-thematic fund called the Transformational Changes ETF, which looks at 4 areas that we think were accelerated by COVID around the future of work, genomics and telehealth, digital consumer, and food revolution. And then we also have a long-standing infrastructure product called Tolls, which differentiates itself because it's the infrastructure owners rather than the construction companies. So it's the toll collectors, if you will, and the people who own the ports and who fund the airports. So those are that is our suite as a whole. So we're focused on areas of high growth. There are really 3, if you will, pillars that we rely on. One, we look at changes in technology and the impact that has on the economy. We look at changes in consumer behavior, and then finally demographics. And so that's kind of a common element across all of them, and some products hit on one, some hit on more than one. And we will continue to be looking at the more innovative and disruptive parts of the economy. I don't think that would come as much of a surprise that bear on those 3 types of issues. The question that we constantly grapple with is what structure we want to put around these and how narrow we want to be. And so, for example, I would argue that the Pet Care ETF, which I think, by the way, is brilliant. Some people think it's sort of a cute idea, and then when you point out that people are spending more money on pets than ever before, there are more households in the United States with pets than there are households with children, and that you get an element of consumer staples where people keep feeding their pet, as we saw even during the pandemic. A matter of fact, we saw pet adoption rise. And then there's also pet healthcare, which, by the way, isn't subject to regulatory risks the way the human healthcare sector is based on potential government policy. So that's an example that's pretty narrow in its focus. And then you look at something like transformational changes, which takes a wider purview of the economy. And so as we're thinking about developing products, whether it is in the cybersecurity space, industrial automation is one that we find really fascinating. The future of entertainment and the on-demand economy, whether it's gaming, esports, virtual reality, are really interesting. Clean tech, future of mobility, all those types of issues are things that we focus on pretty closely. And then the question is, how can we wrap it in a way that we really think is delivering value and differentiation for investors?
Right. So I noticed that, Pets has all the companies you'd expect: IDEX, Freshpet, Chewy, Zoetis, Trupanion. It also has Nestle and Merck. Are those 2 together are 8% of the assets, and 70% in the top 10. That is a tight focus on a pretty small group of companies, and it's not a very big fund. It's like 200 million in net assets, but it's an interesting idea, and I get it. Some people, it's probably a pretty long-term trend, I would guess. It makes some sense to me. It does. It's narrow, but it makes some sense. But the transformational changes is kind of more interesting to me. The motivation of it sounds like it was really motivated by COVID. Is that what that's what you're telling me, right? It was motivated by this enormous transformation that happened. And so does somebody think that this is going to be a really, our society has changed permanently? That's what you're telling me, right?
I do think society has changed permanently, but I want to be really careful that the fund, first of all, let me be clear, is not a doom and gloom fund. It's not about things that are immediately impacted by COVID. It is really about the trends that were accelerated by the pandemic. So, for example, take online retail, take e-commerce. It had in 2009 about 5% of total retail was done online. By 2019, that number was up to about 15%. I'm sorry. It was 10% or 11% by 2019. So it took a decade to basically double from 5% to 11%. It then shot up in 2020 during the pandemic from 11% to 17%. So that same 6% growth that it took penetration, that it took a decade to achieve, it then achieved in the course of a matter of months in 2020. And I don't believe that number is going to go down. I don't think we're going to see, a return to e-commerce as 11% of the total retail. I think we're going to continue to move up towards 50. And so that's an example of a trend that was accelerated. Remote work is another one that's kind of interesting, where you had roughly 7% of the population working from home at the end of 2019. That number, according to Stanford, by spring was up at 42%. So that was a phenomenal. We're not going to grow at 6-7 times from 42%. 250% of people can't be working from home, Dan.
Right.
But I think that that represents the types of transformational changes. So I think saying that society is forever changed is perhaps a little bit more existential than I'm comfortable jumping into. But I do think that these trends in technology and how technology applies to our everyday life do matter. I can tell you, by the way, it's fascinating. Go and Google trend the term mRNA for messenger RNA, because genomics, while people understood that there were some things going on in genomics, the whole idea that we would have a mass scale use of genomic treatment at the end of 2019, by 2021, I think would have shocked most people. And yet here we are, we're using this messenger RNA. It's the baseline for the Pfizer and for the Moderna vaccines. And, not surprisingly, Google Trends, people are Googling what mRNA is, which, by the way, it's the, little slices of DNA that holds codes, or RNA in particular, that holds genetic instructions for what your cells to do. And we're trying to get your body to produce antibodies to COVID without having to directly be exposed to the virus. And it would have been years, probably 4 to 5 years, before we would have seen RNA genomic vaccines used at mass scale. And yet that's been compressed. And I think we only go further. So there have been all these things that are very tangible to people today, but what it represents for the future and opportunity, we think is much bigger. And so to us, these are trends now that will play out over the next 5 or 10 years and that are accelerated as a byproduct.
Okay. What about the long online short stores fund? I would, if I owned that, I'd always be sort of, especially right now with stocks like, GameStop and Express just getting, the shorts are getting murdered and the stocks are up 100% in one day and stuff. It's an insane moment, but it's not a bad moment to think about, the risks that might come along with owning this long online short stores ETF. But for me though, there's also just the long-term proposition. Like, how long can you be short stores?
Well, 2020 did see record number of store closures, but before I dive into that, I think it's really important for investors to understand what they own and why they own it. And so we actually have, and we call it the retail suite. We have the short stores ETF, we have the long only online retail, and then we have the long short combination. And so all structures are not going to be right for all investors. And I think that that's really it's really important to understand. People need to recognize that all ETFs are not built the same. Some of them are passive, some of them are built on well-known indexes, some of them are built on custom indexes, some of them are active, and some of them take a significant amount of active risk and can have very, very high concentrations in specific stocks, and are quite frankly more like long only hedge funds. And when that runs great, it runs great. And I think that the long short type of strategy is reflective of that. For a very long period of time, online retail was growing. Brick and mortar was shrinking, and as I said, we saw record store closures and retail bankruptcies in 2020. And so there is an argument to be made that perhaps during the peak of quarantine and economic lockdown, that was going to be the worst for retail. And if so, then perhaps you wanted to hop out of the long short strategy and move into the long only. If you take a longer term view and you think that there is still more to go in the secular reduction of stores, which, by the way, the United States is massively over retail, right? I think it's something like on a per person basis, we have 1.5 or 2 times the amount of retail space that they have in Western Europe. And so there's a perfectly reasonable argument to be made that needed to come down over time, and that e-commerce is just pushing it. But the other element of this that I think is really important, beyond just the long short structure, is people are using the long only retail as actually a replacement for their sector bet in consumer discretionary. Because if you think about what sits in consumer discretionary, you get retail, both online and brick and mortar. You also get travel and you get autos. And in 2020, let's face it, 3 areas that we thought were going to come under pressure: brick and mortar retail during lockdown, travel as we all started staying home, and your auto didn't necessarily feel like it was a needed purchase when you weren't commuting as much. Now, it turns out that last one had a much more complicated thesis than I think many predicted throughout the pandemic. But what we saw is people abandon their sector bet in consumer discretionary and move into online retail with the simple logic: why do I want to own the whole sector when I believe that there are pieces of it that are going to face both challenge in the near term because of COVID and potentially secular challenges over a longer recovery. And so I think the long short logic is really just gets to what is the right structure to be delivering that investors should choose, and that's part of what we should be thinking about as we're designing products on this side of the business.
Sure, I get that everybody's different, and it's up to you to assess your risk tolerance and your time horizons and what's right for you. Maybe a long short fund isn't right for you. But I still have that question though, Scott. I still wonder, with any short fund, like how long can you be short? It's an odd thing to me to be kind of permanently short, the way a fund like this implies that it will always be short stores to some extent. And to me, I like, it seems like a great idea for the moment, sure. But I always wonder, how long will this product last? Will it be managed such that one day, ProShares will say, something, this has probably run its course? Or will they just, let it exist as long as anyone has a use for it, which makes sense, right? Let the market determine it. I wonder what the thinking is from ProShares' perspective. You just let the market determine, I would assume, what it wants and needs.
Well, we're constantly auditing the products to make sure that we think that there is a reasonable justification to have it in the marketplace. I mean, we do tremendous due diligence on, or relatively deep due diligence on everything we launch. At least at ProShares, I can tell you, we don't just see something and oftentimes roll right out. For us, it's a multi-month exploration and launch process. And similarly, we take it seriously whether we should keep products in market and for how long. So I wouldn't want people to think that it's simply there just because it was already produced. For us, I go back to that. If online retail is currently 16 or 17% of total e-commerce, and by the way, the fastest growing, Washington Post published this the other day, the fastest growing segment or cohort within the US in online retail are those 65 and over. So for those of us who thought that some of these technologies were a young person's game, move over youngsters, online grocery is booming. And I think I do intend that pun because we're seeing things that were never bought online before that are now moving online. More Americans have now bought groceries online than ever before, and the vast majority of them say they would do it again. And so if we're only at 16 or 17% penetration of e-commerce, then that suggests to me that there is still a pretty long way to go on this short retail theme. And if we were to turn around a couple of years from now and e-commerce is 50%, maybe that's a threshold that we would turn around and reevaluate whether we thought that a long short should stay in the market. But also keep in mind, the long short offers two possibilities. One is that e-commerce continues to go up and brick and mortar, goes down. And so that's the best of both worlds. But it's also a hedge strategy where you're just buying the faster growing of the two segments. And so, if you're really going for that double whammy, then that's one option. But you should also buy it recognizing that, as the whole market goes up, brick and mortar retail in a reopening, which is the trade that's underway a little bit right now, could do well. And then the question you want to ask yourself is, using that as your hedge, do you think e-commerce will continue to outpace? Which is really what a long short strategy is really made for, is to capture a differential. And that might be, a double positive if one's up and the other's down, or it could just be a market hedge as one just outpaces the other.
Right. Okay. Yeah. I mean, I'm not saying there's no place for it. I'm just saying I do have questions about any ETF that involves short selling, because to me, short selling is like this highly opportunistic type of a strategy. Like always being short strikes me as a little odd. But of course, there are, wealthier people than me who have made a lot of money, running long short funds. So, I get it. Where do you want to take this? Like, are you always going to be the thematic guy? Is this just where you are for now? Do you have, what is Scott Helfstein's vision? What's your big vision about what you're doing right now with ProShares?
I think that innovation in the economy is tremendously important, and finding ways to express those views and give investors a means to try and stay a half a step ahead of the game. And I say that recognizing, there's been a lot of discussion lately about themes that are, kind of late. Something already pops, and then a product comes out, and so everybody's going to be a little bit, depending on how you classify a theme, that's always going to be an issue. But I really think about long-term growth prospects, and that's been my approach to investing for a long time. And then if you overlay the importance of secular change right? Secular, technological, and economic change on top of that. Um, you know, I like the idea of just bringing creative ideas to the market. We call it conversational alpha. I talk about the power of narratives. And so my heart, in my soul, Dan, ultimately, I'm a researcher. We started out with it. I've got a PhD in political economy and public policy. I, was a professor for a number of years after working at the Fed and being a banker. And so, I love doing analysis and trying to come up with fresh ways to see the world, and try and, to the extent any meager mortal can, forecast a little bit about what comes next. And so, whether it's in thematics or whether, there's another umbrella ultimately that's put around it, you can call it megatrends, you can call it innovation. It, these are the types of ideas that really get me out of bed in the morning. And other than my kids waking me up, which as they get older happens less and less, which is pretty great, by the way. So I this is the space where I want to be, both from a research and from an investment perspective. I think the ETF package is a really efficient way to deliver it. And the market will continue to evolve, and we'll see where it goes from there.
I like the fact that you said the word innovation several times in that answer, because that's the great, I think, in my humble opinion, unstoppable force. And it's the reason why even though I'm kind of bearish, I mean, kind of bearish. I've been really bearish here on the podcast for some time now, but I tell people, don't sell all your stocks and bonds. Don't sell it all and go to cash and head for the hills. Keep your stocks and bonds, because you always need exposure to the relentless ascent of man, to use Jacob Bernowski's expression, and that relentless innovation. So you're talking my language now. That's a great answer. I have one final question for you today, Scott. It's the final question that I have for every guest that I've ever interviewed on the podcast here. So with all that you've sort of taught us about thematic and ETFs and stuff today, if I were to ask you to leave our listener with just one thought, just one good nugget, if you could, what would it be?
I think people should, and this is going to be right in line with what you just said, Dan, they should be trying to future-proof their portfolios, because you are spot on. We continue to advance. We continue to develop new technologies, push frontiers. To think about where medicine could be 10 years from now could well make medicine today look almost like the Dark Ages, right? In terms of healthcare and the innovations that are ahead. And so that to me is really important. Investors try and break out of some of these traditional paradigms and really look under the hood. And I think something like a pandemic and a recession is really a great time to do it, because people are getting new information. They're seeing the world a little differently. And I think it's really important for people to understand that, leaders today might be leaders tomorrow and they might not. And to really focus on the power of ideas and try and make sure that they're invested, not just for today, but for the things that are coming.
Oh, yeah. Good answer. I appreciate that, Scott. I agree. Times of crisis spur huge innovation. War, pandemic, Great Depression, what have you. Those times spur lots of innovation and ultimately lots of entrepreneurship. Thank you for that. Excellent. And thanks for being here, Scott. Maybe we'll be able to check in with you and see how the world of thematic investing is going in the next 6 or 12 months or something.
Love to be back, and I appreciate the time.
All right, that was really interesting. I really have seen thematic investing like literally in 2 or 3 news articles, and haven't thought a lick about it, not anything. So, having the guy whose job is thematic investing at ProShares is about as good as it gets. And it is interesting. And those funds, go to ProShares.com, and the front page has ETFs by type, and then click on thematic. And the names of some of these things that I read off, the decline of the retail store ETF. Man, that's so specific. I wasn't expecting that. It's pretty cool, actually. And it makes a lot of sense. It makes a lot more sense to me than, like Scott was saying, value, growth, quality, all these things that people have been making ETFs out of lately. Yeah, cool. All right, let's look at the mailbag. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. If you don't want to write in, you can now give us a call. Yes, you can give us a call at the new listener feedback line. Just call us at 800-381-2357. That's 800-381-2357. Leave us a message. Tell us what's on your mind. All right, we'll start this week with TJ. TJ says, Dan, this was very good, but I have a question about Bitcoin that was not discussed. Utility. I only hear Bitcoin referred to as a store of value. To be considered a store of value requires relative stability. Bitcoin is not stable. It appears to be orders of magnitude more volatile than gold. Stability may well come eventually, but its value seems to be tied strictly to its limited supply and what the next guy is willing to pay for it. It's too slow to be used for financial transactions. It doesn't appear to have any utility except in those few areas of the market where it is accepted as payment. Gold is a store of value that has 3,000 or 4,000 year history of having utility, and I can hold it in my hands. Now, having said that, I have made a small investment in Ethereum, Cardano, and Ripple. I picked those because they all seem to have utility, or perhaps a better way to state it is future utility. Am I missing something in my utility analysis? Keep up the good work, TJ. I don't know that you're missing something. Bitcoin is the same deal as the other stuff you're buying. Eric talked about that last week on the show when we talked with Eric Wade. It's a place, you're buying a place in line, and we're not sure what you're going to get, when you get up to the front of the line. But it's the same thing. There's possible future utility. We're not sure exactly what. And as far as the store of value goes, I wonder, is it an 11-year-old store of value, a burgeoning, still very new as a store of value, a lot older than gold, a lot younger than gold, a lot younger than real estate, right? A lot younger than, art and all these other things that people, silver and collectibles and whatever. Just about anything I can think of, it's this brand new thing. 11 years old constitutes a brand new newborn store of value. So maybe the volatility is, as you alluded to in your question, you said stability may well come eventually. And if it really is a store of value, the initial extreme volatility might be okay. But, I want to go on record here, though. The volatility, it concerns me. I'm not saying there's not reason to be concerned. I keep telling people on Twitter and on this program and elsewhere, Bitcoin trades like a friggin' biotech stock. It's just going straight up. It's going ballistic. And ballistic charts scare the hell out of me because they never correct by going sideways. They correct by crashing. And maybe what we have here is, Bitcoin crashed from whatever it was, just call it 19,000 to 3,000 back in 2017. Maybe this time it goes to 100,000 and crashes back to, 40 or 30. Right? Higher highs and higher lows over a long period of time. That would keep the bull intact and keep Bitcoin rising in value. But I don't want to make anybody think that Bitcoin is a slam dunk and is just going to go to infinity from here. I don't think that. And, the jury is still out on it. As long as the volatility is that extreme, in any direction, up or down, the jury is still out. Thank you, TJ, for bringing all this up. It's worth keeping in mind. Next comes Jonathan A. And Jonathan A. links to a Bloomberg article, Peru is selling century bonds just days after political crisis. That's the name of the article. It was from November 2020. And he's got a quote here. It says, investors are looking past the political noise as the combination of low global interest rates, a weaker dollar, and large fiscal stimulus packages increase the appeal of some developing nation assets. Peru's sale included 12-year bonds priced at 100 basis points over U.S. Treasuries, as well as 40-year notes and 100-year notes with spreads of 125 and 170 respectively, said a person familiar with the matter who requested anonymity as the details are private, end quote. And then his email continues, this sale was accomplished in the face of the following experience. Another quote, he says, Peru itself has seen 8 external defaults and restructuring since its independence in 1821. According to the book, this time is different, 8 centuries of financial folly, end quote. And then he finishes by saying, need one say more to justify going to cash and waiting out the coming correction? The inherent contradiction being that this news is 3 months old. The market continued to rise sharply. Jonathan A. Jonathan, thank you for pointing this out. I'm very happy to have read that to our listeners. I thank you for sending it. And it is crazy. 100-year bonds from Peru. First of all, a 100-year bond from Peru is a little too optimistic for me. You're right about that. And then at 170 basis points over U.S. Treasuries, which, I guess that's a 10-year or 30-year, I don't know. But there's no corresponding Treasury. It's crazy. It's insane. But there's nothing else need be said. Next comes David A. David A. says, love your podcast. I have learned so many useful things about investing and the economy in general since I started listening. I do own Bitcoin, but here's one of my greatest concerns. As Bitcoin grows in value, and if I sell it for dollars, I have to pay taxes. I want to be able to use my Bitcoin/Ethereum as a typical nest egg where I earn passive income from my holdings. Then I only owe taxes on income that I pull out for use in the dollar economy. It seems that I have to give up the safety of a cold wallet in order to do that. Once out of the cold wallet, I'm exposed to hackers, government invention, etc. What are your thoughts? Thank you, David A. Yeah, you're absolutely right. You either put it in the cold wallet, which cuts it off from all connections, to the internet, or you have to interact with others and you do expose. Now, I don't know what the odds are of getting hacked and the government intervention, you understand that could affect the value of what's in your cold wallet, right, David? So I just want to throw that in there. Eric has actually written about ways to get income from Bitcoin. But the last I heard, he felt that it sounded to me like he was starting to say, well, it's played out a little bit, so I'm not as excited about it. But you'd have to read Crypto Capital, his newsletter, to get more information about that. And that's not me trying to sell the newsletter. That's me saying, I don't know. Our next question is from Michael K. Michael, thank you for the brevity of your question and your whole email. The entire email says, Dan, what do you think about shorting the S&P 500 as portfolio insurance? You're awesome. Show is awesome. Done with compliments. Oh, I see. He says he's done with the compliments now because he just gave me 2 of them. Michael K. So Michael K., thank you for the compliments. It's okay if you're done with them when you give me 2 in a row like that. What do you think about shorting the S&P 500 as portfolio insurance? Well, I must think it's a good idea because I've been buying put options on the S&P 500 periodically, not all the time, for like 3 years. I bought them in September of 2018. That worked out great. It worked out better than I actually profited from it. I got out too early. And I own some right now at various strikes and various maturities. I think I'm at May, June, and then September, and then December. But yeah, I mean, there are times when it makes a lot of sense. And there are times when I know people who never dabble in this stuff have bought them. And I think that moment in 2018 was one when Vitaly Katzenelson, who I know just wants nothing to do with options most of the time, I think they bought them at that time too. I know he bought them at some time or other. So yeah, it makes sense to me as long as you spend a small amount of money doing it, right? The point is you can spend 1% or 0.5% of your portfolio or whatever, and if you get a real horrendous drawdown in the market, that thing that you hopefully bought at a really cheap price could be worth 10, 20, 30, 50, 100 times. And here you are cashed up and ready to go with the market down, whatever it is, 20, 30, 40% or more. So when it works out great. But most of the time, the overwhelming majority of the time, if you continue to hold to expiration, you're just going to lose every penny you put into it. Next comes Vicente, and Vicente says, 2 subjects. On Bitcoin, if an entity goes and buys all or almost all of it, and if that entity is the Fed, it's only 890 billion. In other words, Bitcoin's market cap is only 890 billion. In these days, it's kind of easy. They just print the money. If out of 21 million Bitcoin, there are only 1,000 or so Bitcoin, does that kill the market? Would it be kind of over? Yeah, I think the odds of the Fed doing that are like nil and almost nil. But look, what would happen if they bought almost all the treasuries? Well, treasuries would be negative interest rates because the prices would be triple what they are now. So you might have trouble selling into a market that illiquid, but if the Fed keeps buying, then you sell it to them. I don't know. I mean, if the Fed is printing money and buying the daylights out of Bitcoin, sell to the Fed, man. Just sell to the Fed. I don't think that would be a terrible thing after all. That would be like the inflation moment. Of course, then what do you do when you're in cash, right? That would be the real question. If you sold to the Fed because you didn't want to be in a market where there was like 1,000, effective float of Bitcoin, then the real question becomes, what do you do with the money now that you've sold out to the Fed at, 10x whatever you paid for it? Because they would run, if they tried to do something like that, Bitcoin wouldn't be 50,000, it would be 500,000 or 5 million or something, or 50 million. It would be insane. Number 2, Vicente says, please help to understand this consciousness on investing. Not sure what that means. It says, if I stop buying Altria, the company that's famous for owning the Marlboro cigarette brand, will that affect something or anyone? Who cares? If we stop buying, the price will drop and someone will buy it based on cash flow profits. So does all this new movement make any sense? Stop buying sugary water companies like Coke and oil companies due to climate change. Does that make any sense? Can we vote with our dollars? Thanks. Great show. Vicente. So thanks for saying it's a great show. I appreciate it. So the question here that you're asking on number 2, Vicente, is could we all get together and vote with our dollars and cause the prices of these companies to go down? And certainly if people don't want them anymore, their share prices will fall. I think these motivations are silly, but what I think is silly doesn't matter to all the other investors. If you don't want to buy Coca-Cola stock or oil company stock for whatever reason, even if it's something as stupid as climate change, which is a really stupid reason not to buy an oil company. Or if you don't want to buy Altria because you think cigarette smoking is really, evil. It's evil to sell cigarettes. Again, absolutely stupid, in my opinion. But, what I think is stupid doesn't even figure in here. And you can certainly vote with your dollars. You can vote with your dollars on any company, but that's all you get to do, I think. You're not going to, if you and 10 other people do it, you're not going to affect anything. But if over time lots of people don't want to own these stocks for these reasons, they could have a problem. It's that reflexive thing. If the share price keeps going down and down and down, and the business is still okay, other things being equal, they won't be as good of a creditor as they used to be. That's my answer. I'm going to stop right there. That's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. I enjoyed it immensely. Okay, if you're listening to this episode and you really enjoy it, send somebody else a link to the podcast so we can continue to grow. Anybody you know who might enjoy the show, just tell them to check it out on their podcast app or at investorhour.com. If you want to hear more from Stansberry Research, check out americanconsequences.com/podcast. And do us a favor, subscribe to our show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. follow us on Twitter. Our handle there is @investor_hour. If you have a guest you want me to interview, drop me a note at feedback@investorhour.com or give us a call on our new listener feedback line. Call us at 800-381-2357. That's 800-381-2357, and tell us what's on your mind. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.